Just a really quick risk disclaimer. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or a delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that the account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. And then along those same lines, we're required to show you CFTC Rule 4.41. Just a really quick hypothetical disclaimer. It's saying that obviously if we're showing you historical charts that happened in the past, so it's easy to say, look, it worked great, but that's a past chart, so there's no guarantee that it's going to continue to work that way. So with the disclaimers out of the way, let me go ahead and pull up TradeStation. I'm going to do it a little bit differently this time. Instead of putting together a slideshow and everything, what I've done is I just want to pull up crude oil and show you some examples of the strategies and the trades that I'm talking about and what they actually look like on the chart. So we can look over the past couple of days at what crude oil has done and where you would have been able to scalp this market. So I want to make sure everyone can see TradeStation really quick. If you can see, my TradeStation should be crude oil on a 2-minute chart. If you can see that, then we are in good shape. Now there's a couple different strategies that I want to talk about with scalping, that can be used with scalping. These are essentially my favorite strategies for scalping crude oil. One of them is using 2 or 5-minute charts. So you're using a 2 to a 5-minute chart, and you're trading divergences. With momentum. The other strategy that I like using for crude oil, for intraday scalps and for short-term trades, is trading on a 5-minute chart and trading 5-minute breakouts. And we'll talk about both of those here today. And then the last strategy that I like to use is not a time-based strategy, but it uses tick charts, and it's using a 250 tick chart. And it's a really simple trend following strategy. Now it's not using the EMAs. If you're in the trading room, you know we have an EMA strategy that we talk about a lot. It's not using EMA strategy. It's a different strategy, and I'll show that to you here in just a few minutes. So first, let's go ahead and start off with trading the divergences on a 2-minute chart. Now, when you're trading these divergences, you want to make sure you're doing it during prime trading hours, okay? So you don't want to be trading during the night session. You can see here, this is in the middle of the night. See how choppy crude oil gets, where you have gaps between the open and the close of the bars. The market's just kind of chopping around during the night session. You don't want to be trying to trade these divergences during that time. The best time, in my opinion, to do it is from about 6 a.m. until about 3 p.m. All right, that's when you're going to have a lot of really good setups. So let's go ahead, look over here. Starting from right here is about where 6 a.m. is, and you can see we start picking up volume. Market starts actually moving around a little bit. So what is a divergence first off? First thing you're going to want to know is how do you actually identify a divergence in order to be able to trade it? Well, a divergence occurs when your prices move one direction and your momentum moves in opposite direction. So here's your first low, and here's your second low for momentum or for price. So your lows are just about equally as low. You're moderately undervalued as shown by the lower yellow bar segment here on your value bars. And then you look down at your momentum. You have a significantly higher low on your momentum on the second low compared to that on your first low. So you see your indicator line on momentum is much higher. Your histogram on momentum is much higher. So this is a buy. Now when you're scalping, all right, normally your goal when scalping is to take out about 10 to 15 ticks. When I'm trying to scalp crude oil, I'm looking to take 10 to 15 ticks. So profit target is 10 to 15 ticks from entry. That means that you're only looking to make $100 to $150 a contract per trade. Now the tricky thing about it is when you're scalping, okay, you're trying to catch these smaller moves and profit from these smaller moves, you still don't want to be risking your reward risk ratio that much. All right, so the most I really would want to risk on a scalp is about 7 to 10 ticks of risk. So that way you're still keeping about a 2 to 1 or a 1.5 to 1 reward risk ratio with your trades. And when you're doing this, keep in mind when you're trading these scalps, you're waiting for the really good setup, and then you're not trying to catch the giant move like this, which you can if you have longer term reason to believe that it should go down further, but you're looking to catch this move right here from undervalued up to overvalued. That's where your money's made when you're scalping. All right. So the way that this works for a divergence, you're looking for, in this case, a bullish divergence, so low 1 and then low 2 with stronger momentum lows. So your momentum is higher even though prices are just about equally as low. So you're getting long right here. Now when you're long right here, your stop is going below this low here. So your stop gets placed right down there below that low. And then your profit target is hit as soon as you're overvalued. Now what we call this is value range trading. Okay, value range trading is going long from undervalued or short from overvalued and then covering at the opposing value level. So if you're long from undervalued, you get out overvalued, or if you're short from overvalued, you get out undervalued. Okay, again, it's a scalp. Unless you have a much longer term outlook that's telling you should get a bigger move, then you're looking to do this short term 10 to 15 ticks. So here's your first opportunity. You had a nice bullish divergence there. You had the scalp, be okay to get in there again. The next opportunity right here, you came all the way down undervalued again. So let me erase the ink. So this was your first trade, long in between there. Your second opportunity is another bullish divergence. So you see your momentum indicator line significantly higher. Prices came all the way down, moderately undervalued again. Your stop is going down below the previous low. So remember, the first time your stop was down here. The second time, when you're entering up here, your stop goes right here. All right, stops below the low. You're in here. You're out at overvalued. So you're taking out this move right here. Now again, it's a scalp. The best way, the stop is at 1 tick below the previous low. I like to put it 2 to 3 ticks below the previous low, depending on how close it is. Because sometimes the market will break the low by a couple of ticks before reversing. So again, stronger momentum, another undervalued dip where you have another bullish divergence in and out really quick. This is about a 4-minute trade. You made $100 a contract, a little bit less than that probably, depending on where you got out. So the next option, you see here, you're not taking this long. Make sure you're waiting for, although it did dip down here and then continue higher, make sure you're waiting for those high probability setups because you're scalping. The thing about trading these divergences is you really don't care what direction the trend is if you're trading the divergences, because all you're looking to do is catch the short-term pullback. So you're looking to profit from these very short price swings. The other thing that I will say about divergences, if you're trading these divergences like this and trying to scalp, you have to have very, very precise entries. Okay, so you need to make sure that you are in it at the right time, because if you don't, if you're in it 3, 4, 5 ticks late, you missed half the move because you're scalping. So here's another opportunity here. You had a bearish divergence. So you had high 1, high 2. You look at your momentum, high 1, high 2. If you've been in any of the workshops or anything, you know this is called one green finger right there, and that's a very bearish setup. So you're in it short at overvalued. So up here, your stop is 2 or 3 ticks above this high. You're out at undervalued right down here. So you're taking out that move right there. Now it did reverse and go right back up, but that doesn't matter to you because you were looking to catch that little move right there, the scalp. The next opportunity, we'll go ahead and move on. You can look at, again, make sure when you're trading these, you're looking to take the best setups, okay? So you're looking to take the most obvious ones. You may get 4, 5, 6 a day that are really, really well defined. So down here, technically you could be calling this a bullish divergence because your histogram is like this. I wouldn't be taking that. This right here, I would be taking. So there's your high, here's your second high. Look at your momentum histogram. Significantly weaker on the histogram, significantly weaker on the momentum indicator line as well. So you're short from right here, overvalued, stops at the high. You're out down here, undervalued. So you had a nice scalp there. It's about 15 ticks. Not a bad move. Next opportunity you have, you're waiting, you're waiting, you're waiting. You don't really have another opportunity again until you have what we call the no return down here, where you have another bullish divergence, higher momentum lows, even though prices are undervalued, just about equally low. But this is called no return because you went undervalued, so lower yellow price bar, but you stayed in green momentum. So your momentum stayed up even though you had undervalued prices. So you're long from right here. Stop goes below the previous low. You're out as soon as you hit overvalued. Again, another 15 ticks or so, and you're risking about 6 or 7. So not a bad one. Please explain why I would not take that first divergence, the histogram divergence. You're talking about this one over here? This one right here? Because the higher probability divergences are the ones where it's broken, where it goes green, red, green, or red, green, red. All right? Those are the highest probability ones. The ones where they're connected like this, you have a lower probability of success when it never goes green again before making the move. You enter on the close of the bar or one tick above or below the bar. You're entering when you get undervalued. If you're undervalued and within 2 or 3 ticks of the previous low, you're getting in it. Okay, so you see here you're about 4 ticks away, maybe a little bit less than that, 3 ticks away. You're getting in it as soon as you're undervalued. You have to be very quick. If you're waiting for the bar to close, the move's halfway over. So these are trades you're expecting to last between 10 and 20 minutes at the most. Yeah, 20 minutes is probably too long. You should be in and out within 10, maybe 15 minutes. Again, these are just short-term scalps that you're looking for based off of 2-minute divergences. Now, you can also trade longer time frames, all right? If you want to catch a little bit bigger move, you don't want to trade for the 10-tick move, you want to trade for the 20-tick move or the 30-tick move, then instead of using a 2-minute chart, change it and use a 5-minute chart. Again, make sure you're trading during the high volume hours, so right in the middle of the day. You go back and you look during the night session, really choppy markets during the night session. You see right in the middle of the day when the pit hours are open, that's when your best setups are going to happen. Now, if you're trading off a 5-minute chart, you'll be lucky if you get 1 or 2 really good setups a day. All right, so let's go ahead and take a look at, this is today's price action. Let's see what we had, see if there were any divergences. And honestly, there really were not any great divergences today. So there you go. There's a day that if you were trading 5-minute divergences, you didn't really have a good setup. You had some mediocre ones, but nothing too spectacular. So let's go back, look back in the past a little bit further, see what we can find back here. Here's a really good setup. Remember the no return? So you're coming over right here. Here's your first low. Here's your second low. Here's your first low of momentum. Here's your second low of momentum. You came undervalued with green momentum, so you had no return. So you're long from here. Your stop is below the low. You're out as soon as you hit overvalued, which is, in this case, about 30 ticks above, 35 to 40 ticks above. Up here, you had another nice no return. Overvalued right there, no upside momentum. So you were overvalued, so upper yellow. Your momentum stayed red. So you're short from the overvalued price point. You're out as soon as you hit undervalued. You had another one green finger right here. So you're short on the one green finger. You are out undervalued. All right, so pretty simple. You're just looking at short-term time frames, trading the divergences. Make sure you're trading the best ones. My preference for crude oil is a 2-minute chart or a 5-minute chart. Make sure you trade the best divergences, and then make sure you're getting out at the appropriate time. So you're looking for the value range trade between undervalued to overvalued or overvalued to undervalued. So the second setup, remember we were talking about short-term breakouts. This is, you're looking at a 5-minute chart. Let's go back over and look at today's price action. You look at a 5-minute chart. Now normally this happens going in around noon. You're going to get your setups a lot of times. Sometimes it'll be a little bit earlier than that. Sometimes you'll get some earlier in the morning. But what you're looking for are breakout patterns. So you're looking for trend lines, you're looking for support resistance, and you're looking for the market to break through those. For example, you have a trend line going up and across these lows right there. Let me, instead of trying to draw that, let me actually just use TradeStation's trend lines. Make this a little bit easier myself. So you have a trend line going up and across these lows right here. So what you're doing is you are going short as soon as you break through that trend line. Now again, you're looking to scalp it. So you're not looking to catch a huge move. You're trading off a 5-minute chart. So you're looking for really this initial break. So as soon as you broke through that trend line, you see within a couple minutes, you already had a drop of about 10, 15 ticks. As soon as you get that drop, you're out of it because it's a scalp. All right. The other thing you can be looking for is obvious resistance levels. And this is why this is a scalp, by the way, because you're not looking to catch the follow through. You're looking for the initial break that happens. A lot of times it'll happen within just a couple seconds of breaking the trend line. You're looking for this right here. So you're in it long as soon as it breaks the trend line right there. So your entry is 1 tick above the resistance, which is all those previous highs right there. So you had 1, 2, 3, 4, 5 bars that all topped out at the 100.7. You're in it long at 100.8. So 1 tick above that bar, and you're out as soon as you get overvalued. Again, normally it's going to be just a couple seconds. A lot of times this is a very high probability trade for a scalp. So you're looking just for a few ticks right away. And if you do it right, and if the market behaves correctly, it should happen right immediately after it breaks. Like I said, a lot of times it will happen within just a couple seconds of that trend line being broken. All right, let me answer some questions really quick. So are these trades that you could trade? Explain the green finger again. All right, one green finger. What one green finger is it's when you go, if you look at your momentum, all right, the NQ momentum, the way this works, green histogram bars mean upside momentum, red histogram bars mean downside momentum. One green finger is when you have one up histogram bar and then the very next bar is red. Normally, when you get something like that, it means the market is going to roll over and head down. So one green finger is when you have one green histogram bar that points up and the next bar is down, which means you're short on the close of the next bar, which means you'd be short right there. Your stop would be above the high, and then you're looking for it to continue to sell off. Does that make sense? All right, how do you determine over and undervalued to exit? What you're looking at for over and undervalued for exiting, what I have on the screen is value bars. What it does is it plots price in one of 5 value zones. The center green area is considered fair value. So center green equals fair value. Above and below that, so the upper yellow and lower yellow bar segments are moderately overvalued and moderately undervalued. And moderately undervalued. I'm not going to write all this out actually because that's a lot to write out. And then above and below the yellow segments, the red upper and lower red segments are significantly over and significantly undervalued. Again, the indicator is value bars. It's the same sort of thing as value charts, except it's plotted over top of your price bar. Now, one thing I will say about this, if you want to try to catch bigger moves, you can look at, instead of using a 5-bar analysis period, which is what I use when I trade on my value bars, I use a 5-bar analysis period. Instead of using that, I'll look to use maybe an 8 or a 7-bar analysis period. That will spread out. It'll make it take a little bit longer for the market to get over and undervalued. So your profits, if you're doing value range trading, will be a little bit more. You don't see the divergence on the last one at 1300. Are you talking about over here? Not sure. Your scalp target is the opposing value level. So if you are long undervalued, you're out overvalued. Okay? You're doing a value range trade if you're scalp trading. For the one finger trades, you wouldn't know it was one finger until the bar after the one finger closes. So how do you play that before the bar closes? You don't. If you're trading a one green finger, the ones that you're trading before the bar closes is divergences. The one green finger is different. You're waiting until the bar closes to get in that. So in this case, the one green finger, you'd be short the close of the next bar right here. And then your stop would be at the high, and you're looking for the continuation of the downside momentum, just like this. Okay? Yes, again, green finger, you're trading at the close of the bar, not before the bar closes. The divergences you're trading before the bar actually closes. All right, so let's go ahead and go back, look at a couple more examples of some short-term breakouts, and then I'll show you the trend following strategy on the tick charts. Let's go back and find just a random day in the past. Well, this isn't really going to work that great, but you can see there's a couple opportunities here. What you're looking at, again, you're looking at the short-term trend lines. So you have a trend line going across the high here. And actually, this worked out really well. For those of you that are in the trading room, you know how trend lines work. If a market breaks through a trend line, that trend line that was once resistance becomes support. So you could trade the retest right there when it came back down and hit the trend line once again and bounce back up off of it. Again, you'd be long from undervalued and out overvalued. So you're trading just that little scalp there. Now, there's bigger moves that are going to happen. Okay, this is for scalping. So we don't have enough time to go into detail on how to use drill down and understand when to stay in for bigger moves or anything. What we're talking about today is scalping. All right, and even in this uptrend here, by the way, you had counter trend scalps that were perfectly fine to trade, like this bearish divergence here. So here's your high number 1. Here's high number 2. All right, your second high, you're in it overvalued. You had a no return right there. The market did pull back very nicely. The second opportunity was the bearish divergence here. So there's your high number 1, high number 2. This entire thing becomes your new high number 1. This becomes high number 2. If you took the candlestick workshop, you know that's a yellow jacket doji. So you're in the open of the very next bar. You came all the way down undervalued right there before heading higher again. Had a nice scalp counter trend there based off of the bearish divergence. Now, I'm not going to sit here and tell you that it works out every single time, because it doesn't. However, if you're just scalping like this, the probabilities for success are a little bit higher because you're not looking to catch bigger moves. Normally, it's pretty simple, pretty easy if you time it right to get a few ticks or the profit in the money. So again, here's another opportunity here. High number 1, high number 2. High number 1, high number 2. Lower highs on the histogram as well. You're in it short from overvalued. You are out undervalued. All right. Why chart 15 hours long? Wouldn't we be able to see better using it for? Sure, I can make it a little bit larger, make it easier to see. Sorry about that. I had it longer so we could see the trend lines. Can you access the Candlestick Workshop? Candlestick Workshop, we're going to be doing another one here eventually. The recording, I believe, is going to be for sale sometime in the future. It's not available right now, but stay posted, stay tuned. Send the email on to support@valuecharts.com if you're interested in purchasing that. All right, so let's go ahead and talk about the last way of trading it. So we've talked about trading divergences on 2-minute charts and 5-minute charts, and then we talked about trading breakouts on your 5-minute charts. Now let's talk about trading 250 tick trend following. Now the 250 tick chart, if you actually want a scalp where you're looking to take out the 10 to 15 ticks, instead of using a 250 tick, use a 50 tick chart. All right. If you want to catch a little bit bigger moves, you can use a 250 tick. But let's look at, for scalping's sake, let's look at a 50 tick chart. Now the way this strategy works, all right, you have a 50 tick chart, and I am going to condense this a little bit so we can see it a little bit more. What you are following is your MQ regression. So let me actually pull up a new chart so we can see this a little easier instead of having all the other indicators on there. What you're doing when you're trading the 50 tick trend, the way you do this is you use the MQ regression, which is just a very simple trend indicator. You're going to turn this, change the settings on this to a 100 bar length. All right, the way this works, all you do is if this is green, you're long. If it turns red, you close, you're long, and you go short. So you go back and you look at the middle of the day, how this ends up playing out, and you can see what you're catching are these short-term price moves where you're in it here short, so you're red, so you're short, you are out as soon as it turns green. So you're in it from right here, you're out from right here. So you're catching this move there. Again, you'd be long there, the very next bar, you'd be short again, so you'd be in it again short right there, you'd be out right next to it, long, reversing, so you're basically break even here. Then again, you're going short as soon as it turns red. You're catching this entire down move until you're out down here. So you catch that entire move there, which in this case is about 15 ticks. And that's all you're really looking to take out. If you want to space it out a little bit more, so if you don't want to get chopped up as much, instead of using a 50 tick, use your 250 tick or use a 100 tick. So all you're doing, again, is short as soon as it's red, cover as soon as it's green. Same thing here, short as soon as it's red, cover as soon as it's green. So you're catching that move there. As soon as it's green, you're going long, so you're long from here. You're out as soon as it's red, so you're out there. You're short, you get chopped up a little bit, break even basically on this one, and then you're long again, and you're still in it all the way up here. By this time, I probably would have taken profits, though, because you're talking about a 50, 60, 70 cent move. So toss only provides 133 tick at the lowest. Any equivalent regression indicator you can insert. Let's see what it looks like with 133 tick. It may work. You can use it on 250 ticks. Again, just keep in mind the shorter the number, the smaller the number of ticks, the shorter the trends are going to be that you're catching. So the smaller the move. So if you're looking to truly scalp it and just take out the short-term moves that are just a few ticks at a time, you're using shorter. 133 ticks not bad though. I mean, you're short up here, you're covering down here, so you had that down move. You're long from right here, you're covering from right here, so not a bad move there. Short here, cover down here, long down here, you caught this entire up move. Some of the things you can do as well, if you want to be a little bit more reactive, you can, instead of using a 100 bar regression, change that to a 75, or if you want to be less reactive, change it to 125. The other thing you can do if you want to improve the profitability and lower your risk is, okay, you only trade in the direction of the regression, but instead of selling as soon as regression turns red or buying as soon as regression turns green, you are saying, okay, regression is red, so then you look for a divergence, or in this case a double top, where you're overvalued, or you had a candlestick reversal right there where you had a yellow hat doji to get in it short, where you look for the overvalued bounce. So you're making sure if you're going short, you're going short from overvalued. If you're going long, you're going long from undervalued. That'll help you make sure you're in it at a attractive price point. TOS can use any value 133 tick and higher. All right, I don't know why they limit it to 133, but there you go. So again, and then lastly, what you can do if you really want to increase the probabilities of your trades, you want to increase the success rate, combine your strategies. So take the MQ momentum, add it in, use value bars, MQ momentum, and use MQ regression, and then only trade divergences in the direction of the MQ regression. All right, so for example, over here, you had on this 133 tick, your regression was green from right there, and right here you had a no return. Remember, undervalued lower tip with green momentum. So you're long from that undervalued price point, and you had no risk at all. I mean, the low tick on that bar was the undervalued price point, and then it goes straight up. Over here, you're green, don't really have any divergences in your direction. Right here, you're red, so you're looking to short on bearish divergences. So you're selling on the one green finger right here. You are selling on the bearish divergence right here. And you're catching the rest of the move in the direction of the trend. So what's the blue line? The blue line is just an 8 exponential moving average. So if you really want to increase the probability, all you have to do is combine the strategies. All right, so just trade your divergences in the direction of your regression indicator. Remember, the regression, you're not paying attention to the location of the regression. It's not like a moving average where it's going to serve as support or resistance. All you're looking at is the color, red or green. Define no return. No return occurs when you go undervalued with no downside momentum, so you're lower yellow right there, and you had green momentum here, or if you go overvalued with red momentum. By the way, speaking of divergences, look at this divergence. There's high number 1, high number 2, high number 1, high number 2. If that's not a divergence and a half, I don't know what is. So you're talking about, sorry about that, a great scalp opportunity to the downside. You can win, but we're not talking about that today. So before we do anything else, I want to ask a question really quick. Anybody that's in the trading rooms today, or that was in the futures trading room today, we were talking about nat gas breaking out of that 5-minute trend line. Just curious, did anybody take the long on the breakout with me? Because that worked out really, really well. There was a trend line we were talking about. We had been watching it for a while there, all the way up until the trading room closed. You broke out at 4717. Current price is 5018. So you're talking about a $3,000 contract move so far. Not bad. Eating lunch when it happens, you missed it. Yeah. Well, that's one of the things, by the way, this is the same sort of setup that we were talking about with crude oil just a minute ago, where you're looking at your 5-minute charts and looking for your breakouts. Here's an example of one, but this was in natural gas. Did not signal feed it. No, I did not send that out on signal feed. We talked about this probably 10 times, though, in the trading room today, because people kept asking me, what about nat gas? What about nat gas? And we kept saying, still inside the pennant, still inside the pennant. Nice job, Steven. No, we're not going to get into the signal cycle finder today. So that's really about all I had for today. Just want to talk about those few strategies worked out for trading crude oil. Remember, you're looking at divergences on 2-minute charts and 5-minute charts. You're also looking at trend following on your tick charts. I like trend following on tick charts more than I do the time-based charts, because the tick charts, you can have a big up move like this on a time-based chart, where a tick chart, you're going to have all the intraday choppiness that you don't see inside these 2 5-minute bars. So remember, you have the regression strategy, you have your divergence strategy, and then you have your strategy using 5-minute charts and looking for 5-minute breakout patterns. The other thing that's kind of interesting, actually, in crude oil here, speaking of 5-minute breakouts, there's another 5-minute trend line going right across the highs there. You broke through it and shot up quite a bit. So you could have been trading that long as well. So great opportunity there. By the way, for those of you that have been asking about the workshop, when am I putting on the next workshop for momentum? I'm doing a momentum workshop next week, next Wednesday, February 19th. If you go to valuecharts.com/top, I believe is what it is. So valuecharts.com/top, you can sign up for that. It's 3 hours long. We're talking about high probability continuation and reversal patterns. I'm mainly focusing on using momentum, but we're going to be talking about trading divergences, trading golf clubs, inflections, all sorts of good stuff. If you're interested in that, again, it's www.valuecharts.com/top. There it is. Again, that's going to be February 19th, 6 to 9 p.m. This is probably going to be the last workshop I do before I get married at the end of March. So if you're interested in it, this is a really good one. It's going to be doing, again, momentum, trading a lot of momentum strategies, and finding entry points into markets that have already moved, and finding reversal patterns, when to find tops and how to tell when it's going to be a long-term top or a short-term top or just a consolidation period. So that's going to be it for today. I hope everyone enjoyed it. I look forward to seeing everybody bright and early tomorrow morning in the trading room. And until next time, happy trading. Where can you get you're a platinum member, where can you get the weekly prediction webinar? If you go to valuecharts.com, our weekly outlook session Go to the members area, upper right-hand corner. You're going to sign into your account. So again, valuecharts.com, click on members area, sign into your account. On the left-hand side of the screen, once this loads, you'll have a menu that says live analysis. So right here where it says live analysis, you'll click there. Here is our weekly outlook. And if you were in that session on Monday, you know we were talking about taking longs in nat gas Monday night. So that was last night, worked out really well. Nat gas is through the roof today. If you were in the trade room, you know we were long, took off profits once it went into that pennant pattern, and then went long again once it broke out of the pennant pattern. So worked out really, really well. Will I trade orbs at all in my room? I don't typically trade orbs. We can start looking at some orbs if you'd like. It's just there's other strategies that I prefer over orbs personally. What's the setting on regression again? You're looking at using a 100 length on the MQ regression. All right, that's going to be it. Henry, if you want me to look at orbs in the trading room, just remind me, and I'll be more than happy to pull it up, and we can look at some markets for orbs. So we can, the best way to do that is to trade it in the direction of our outlook. So remind me, and we can start looking at some markets that have good setups for bigger moves, and then looking at the orbs for entries. Alrighty, that's going to be it. See many of you tomorrow in the trading room, and until next time, happy trading.